Welcome to Friday Live. Every Friday, some of the partners at HBK Provident get together and talk about what we're seeing going on in the markets, the economy, and then also tying in some pertinent financial planning topics. So to start off, before we get to the market, this is the typical format of our blog posts throughout the week. We have Market Monday, which I do my look ahead post, just kind of a recap of the previous week, things I'm looking forward to in the upcoming week. Brian's been doing a campaign tax Tuesday. There's some very good information on that, and we'll go into those blog posts. Wealth Building Wednesday and Think Ahead Thursday. So the typical format is we cover the markets, the economy, what's going on, and then get into some of our blog posts. So every Friday by 12:30 Eastern time, we go live and discuss what we're seeing. Usually it's me as well as either David or Brian on the call, but Brian's out with clients today, so it's just me. But I have plenty to talk about. There has been a lot going on. We got tons of economic data this week, escalations with Iran. So I'm going to get into the markets first. So let's see here. Let me pull up my chart here. Okay, got to remove that first. All right, so it should click over in a second. There we go. So we've seen a sell-off with this situation going on with Iran that's really escalated. Typically with these kind of geopolitical shocks, it can go one of two ways, especially in terms of fixed income. Sometimes you see a flight to safety where bonds catch a bid and rates fall. But in this case, we're more worried about rising oil prices and energy prices and the effect that it may have on inflation. So as you can see here, I'll kind of zoom in a little bit. We've broken down from this ascending triangle. So it does seem like a definitive breakout. We haven't quite gone below, on a sustainable basis, below Wednesday's intraday low. So that's a good sign, but everything's pointing to getting to this level here around 65.50, which corresponds with the 200-day moving average. So that's kind of my target area I have in mind that the major S&P 500 index could fall to. Now, we were seeing a substantial outperformance in things like the equal weight. I'm looking at the Invesco ETF that tracks that, but it's really given up a lot of ground. This was trading at 6% or so positive on the year, and now it's gotten cut in half. Similar story with international markets have really seen the brunt of the selling. You think the S&P decline is bad. We're looking at, I'd say, 8.5% on the international developed, and now we're above 10% decline for emerging markets. So they're a little more exposed to the geopolitical situation. The dollar has seen a rise, which they tend to do better in weakening dollar environments. But crude, those prices have, I think we're surging to about close to 90 today. So things aren't getting better in that dynamic. So we're just keeping an eye on it. We picked up a few names this week. We got out of one position and picked up two new ones, more around the geopolitical situation. So we picked up an oil refiner, and we got into a steel manufacturer, just in case. I wasn't really concerned about inflation given the growth dynamics weakening, and we'll get into the data in a minute, but overall the labor market has been weakening, so we've been a little more concerned about the growth side of things rather than the inflation side. But the longer this thing persists with Iran, it's the greater likelihood that we're going to potentially get into a stagflationary environment where we could see both inflation rise and growth decelerate. So hopefully that doesn't happen, because that's the kind of the worst case scenario, especially in terms of what monetary policy will do. They're kind of handcuffed in those situations. Their dual mandate is for stable prices and economic growth. So when those go opposite of each other, it creates a difficult environment. And I think the next meeting's March 17th. It's always on a Wednesday where we get the announcement, but unlikely to see a move there, and really probably unlikely to see a move until we get a new Fed chair in place. So getting into the economic data this week, it was we started out the week, I was feeling more optimistic about the economy. We got a strong ISM manufacturing number. It's been in expansionary territory for a couple months now. Really a good reading, 52.4 above consensus in the prior month. Actually, that's around the highest level since August of 2022. New orders are strong. Employment situation was good, although the price index did tick up. So not that great of a dynamic there. ISM services was also beat, remains in expansionary territory. So things were looking good. ADP came in above consensus. That's private payrolls, 63,000. So that was looking good. The challenger job losses were less than the previous month. They were essentially cut in half. So everything was looking good. The beige book didn't have any big surprises, relatively modest changes there. Economic activity, 7 districts reported economic growth as opposed to 8 last month. Employment was seen as relatively stable and prices were seen modestly ticking up. Today was really the highlight of the week when it comes to economic data. We got the non-farm payrolls, which, I've been saying January is always a funky month. It was 130,000 reading last in January. This month, different story. That previous reading was revised lower by 4,000. I expect to see further revisions in that, but we also saw a downward revision for December. But this month came in at negative 92,000. So job losses. So not a good thing for the economy. Some positive aspect, and I'll take that also with a grain of salt. I tend to like February data better than January data, but there was some birth rate adjustments and there were some strikes going on, as well as some weather effects. So, I think we're going to have to see another month to see where this thing goes. But on the positive note, average hourly earnings was good, came in at 4/10, better than expectation, although that's not necessarily good for the inflation picture. Outside of that, the unemployment rate did tick up from 4.32 to 4.44. So not going in the right direction there. And then retail sales, the headline number came in negative 0.2 on the month versus consensus of flat reading. But you go and do the core component, which excludes energy prices and some transportation type things. It was actually a decent reading, coming in at 0.33, I think. So nothing alarming there, but it's really, we need to keep an eye on the labor market and the inflation picture with this dynamic going on. The longer it persists, the more risks to both those mandates. So going into our blog post for the week, the first one was talking about risk of, Tax Tuesday, Brian's post. Oh, I skipped too far. This talks about when you get into retirement, there's a certain strategy where you should hit different buckets differently. And it all depends on your unique circumstances. So talk to your particular financial planner, and we're here to answer those questions. But his post was talking about, first, you like to hit the taxable accounts, and then the IRA types, tax deferred, and then the very last bucket, tax free, because they grow tax free and you can take out the distributions tax free. So there's even more benefit to leaving that in. And Brian covers all that in his financial planning topics. I did put a post celebrating we hit our 6-month goal. We had 1,000 subscribers now on YouTube, so we're trying to keep that building. Wednesday's post was talking about, it was a post that came out from Oxford Economics, and it was just kind of stating the concerns about AI's impact on the labor market and saying that 20% of US jobs over the next 2 decades could be at risk. And the main areas here were manufacturing, particularly transportation was the biggest one, and then retail, wholesale. Going into Thursday's post, it's just, springtime's coming up. It's a good time to take a look at your financial picture, plan for both short-term events and longer-term effects. Events. So short term might be you're planning to buy a car in the next year, possibly a house in the next couple years, and then those longer term things like planning for retirement or your income needs in retirement. So Short little read there, but yeah, all in line with our financial planning topics. We'll keep this segment a little shorter this week since it's just me. Brian usually goes into more detail on the financial planning posts, but we're just going to continue to keep an eye on markets and the economy. As you can see, we're down 1.2% today. We've been having a trend lately that we finish higher, well off the lows for the day. So hopefully that trend continues, but there's just so much uncertainty out there given the labor report we got this morning and the unfortunate conflict that's going on in Iran. So we're going to keep an eye on that. And next week we get some pretty important economic data. We'll get the CPI inflation data on Tuesday, I believe, and then the core PCE on Friday. So I don't know if the higher energy prices are going to seep into that report yet, but it certainly could in future readings, especially if this thing lasts longer than a couple weeks. And originally, the president was saying 4 to 5 weeks he sees it, but it's not seeing any signs of de-escalation yet. And the Strait of Hormuz delivers a lot of oil, runs through that channel. And I think Iran has been planning to kind of use that as a weapon for a decade now. So it sounds like there's likely a lot of mines that could be activated in that region. So hopefully things de-escalate there soon and we can get back to focusing on economic data and the stock market. Before we go, and keep an eye out for our blog posts this coming week. It'll follow that same format. And then Friday Live, next Friday by 12:30 Eastern time. We usually get it out sometime between 11 and 12:30, but you can do the replay on Facebook or our YouTube channel. So keep an eye out for that. And before I go, I'm going to flip on our disclosures. I hope everyone has a nice weekend, and we will see you next week.
Securities offered through LPL Financial, LLC, member FINRA, and SIPC.org. Advisory services offered through LPL Financial, LLC, a registered investment advisor. Brian Peluso, Michael Kutch, and David Harper are registered representatives of LPL Financial, LLC. Content discussed is for informational purposes only and not intended as an offer or solicitation to buy or sell any security or investment strategy. Any opinions expressed are those of the authors and do not necessarily reflect the views of LPL Financial or its affiliates. All investments involve risk, including the possible loss of principal. This communication may include links or references to third-party websites. These links are provided as a convenience only. LPL Financial and its representatives are not responsible for the accuracy or content of such sites. Brian, Mike, and David and HBK Provident Advisors may only transact business in states where they are properly registered or exempt from registration. Please contact us directly for information regarding licensing and registration status. Past performance is not indicative of future results. You should consult with your financial advisor, tax professional, and/or attorney regarding your specific situation before making any